Hi, Jeff. As to your question, who qualifies for a non-QM loan? Let's first start by defining what a non-QM loan is. Non-QM stands for non-qualified mortgage. The importance of that term has to do with back in 2010, when the Consumer Financial Protection Bureau was created, a whole new set of underwriting rules were established for U.S. residential mortgages. And a big focus of those rule changes was to create or focus on the concept of ATR, or ability to repay. That meant calculating, actually documenting your recurring stable monthly income and then calculating a debt ratio against that. If you don't meet the ratio, then you would have trouble qualifying. So that's a qualified mortgage, those programs that meet the Fannie Mae, Freddie Mac qualified mortgage guidelines. That's how that is done. Now, there are a lot of borrowers, however, who do not meet that kind of criteria for qualifying based on ability to repay and meeting a debt ratio, even though their specific situation will involve a pretty significant amount of cash flow that should be taken into account in qualifying, but maybe in a different way. That's what the non qualified mortgage segment provides. It provides loans that are going to be made based on different underwriting criteria, different ways of establishing that borrower is a good credit risk. These loans in general are considered low doc loans, meaning they, in most cases, rely on less documentation than the conforming qualified mortgages. Now, who would be these type of borrowers, or who would be the type of borrowers that this type of loan would help? Well, think of it. The most common, obviously, is self-employed borrowers, business owners. They have always been historically a class that's had a difficult time with mortgage qualifying. This provides them much more options. You've got freelancers, gig workers, Uber drivers, Lyft drivers, etc. You can have folks who are working for cash. You can have folks who have a lot of liquid assets but limited monthly income, whether it be from a job or from retirement and so forth. You have folks who are independent contractors getting paid on a 1099 basis. And of course, then there's the I-10 borrowers. Those are borrowers who have a taxpayer identification number for purposes of paying taxes, but they don't have a Social Security number. So the non-QM space serves all of those types of borrowers who otherwise would be shut out of any sort of reasonable mortgage financing to purchase and own a home. Now, is there a trade-off with the non-QM product? Yes, of course. Non-QM products are encountering or taking into account more risk that borrower profile provides, but they've determined and figured out a way to establish underwriting criteria to adequately address that risk, but that still results in the type of terms you're going to get are going to be a little bit higher, both in respect to down payment as well as your interest rate. And not terribly, much higher, but they're going to be higher. The mortgage rates on a non-QM product, generally speaking, I would say are going to range anywhere from half to maybe as much as 2% on rate. That's going to depend on your loan to value and your credit score. And then in terms of down payment, you're not going to see non-QM loans that are going to offer you, 3.5, 5% down as the conforming, FHA and so forth offer you. But still, the down payment requirements in a lot of cases are relatively modest. In most cases, you're going to see a minimum down payment of 15% or more, again, depending on your credit score, that will increase your down payment requirement. So by and large, it's a question of trade-offs. If you're a business owner and you're running a business that's doing very well cash flow wise, but you're very aggressive on writing off your business expenses to show a very low net income, that's a terrific strategy to reduce your federal income tax liability. But it directly conflicts with the criteria to get qualified for conforming mortgage. The non-QM type product will fill that gap and give that otherwise highly successful business owner a way to get financing to, again, purchase or own a home. A little bit higher rate, sure. A little bit more skin in the games in terms of cash out of pocket for the down payment, yes. But the trade-off is you're still going to be able to have that very aggressive income tax strategy while at the same time get reasonably priced mortgages for your unique employment and income situation. So I hope that helps explain why non-QM mortgages are a very real part of the mortgage industry, and they're a great opportunity to serve an otherwise underserved market. Thank you. Yes, it's actually true that some people have even asked, is a non-QM type of a loan even a good idea? Well, I guess the way I would answer that, and I'm trying not to chuckle too much, is well, of course it is. You have to consider that the non-QM type of a mortgage program, again, this serves a segment of the population who have essentially alternative lifestyles as it relates to business, work, employment, income from your job. These are folks who, in many cases, are quite successful, but they've chosen a different path in terms of operating a business or working than a majority of the population. And so the conforming guidelines, these are guidelines that conform to the two quasi federal mortgage agencies, Fannie Mae and Freddie Mac. Um, a majority of the population can qualify based on those conforming guidelines. We determine, your employment history. We establish that you have a recurring monthly stable income that can be expected to go on for 2 or 3 years, and you have a history to prove it. You actually are able to meet a qualifying debt ratio when taking into account your pay stubs, your W-2s, and even your tax returns. But again, in a lot of cases, there are borrowers out there who are just as worthy of getting mortgage financing to own a home who don't fit that particular profile, that mold. And so this segment was developed to address that underserved segment of the market. So, of course, it's a good idea to have non QM loans. These loans are reasonably priced, relatively speaking. Yes, you're going to have a higher rate than a conforming loan, Fannie Mae, Freddie Mac, FHA, VA, USDA. Yes, you're going to have a higher down payment requirement, typically 15% or more, some rare cases 10%, but I would say as a whole 15% or more. You are going to be experiencing a higher interest rate than a conforming loan. Non-QM loans these days, you're going to see rates that might be possibly high sixes, but into the sevens and even in further into the eights. That usually happens when the credit score is at a lower level and the loan to value being requested is up to the maximum for that credit score. But the point of it is, these programs serve that segment so that they can own a home like everybody else. And there's a variety of options for these non QM loan types. That's actually a benefit, even to, let's say, conforming loans, because the non QM space has a multiple way of getting people qualified. There's 12 or 24 months bank statements. There's the DSCR, the debt service coverage ratio, where you get approved simply on whether or not the loan amount you desire to buy a rental property is going to have a monthly payment that exceeds the actual monthly rent. If it doesn't, you're pretty much approved. You can get a mortgage loan to buy a house with just providing a P&L, or just providing a written VOE from your employer, or just providing last year's 1099 for your independent contractor income. So those are all programs that will help this special segment of the general public who needs to have the ability to get mortgage financing to purchase a home just like any other. So again, I cannot stress enough, this is a great option. Doesn't serve a huge portion of the industry or of the population, but it's very, very important. It serves that need, and it's continually being refined. And so I think in that respect, any of those people out there who are not able to conform to the qualifying guidelines of Fannie Mae or Freddie Mac, there is an alternative. Feel free to get in touch with us. We'll be happy to discuss with you how these programs can help you achieve and maintain home ownership. Who are the best lenders for a non QM loan? Well, let me first say that I would rephrase that question slightly and say, who are the best mortgage originators for a non QM loan? And to answer that, I'm going to remind everyone at Mortgage Works, we are mortgage brokers. When I first got in the business, the first 40% of my career, I worked for a direct lender, a mortgage banking company. But for the last 27, going on 28 years, I've been a mortgage broker with Mortgage Works. Now, as a mortgage broker, we have the advantage of having access to a wide range of mortgage programs, not just non-QM product, but conforming as well. So we can pretty much come up with a mortgage program for almost any situation, any borrower type, for 1 to 4 unit properties, whether it's a purchase or a refi. So start there. I think for a non-QM type product, if you're a borrower that fits that profile and you have that need, a mortgage broker is probably the best originator for you to access or contact to get help with a non-QM loan. Many of the big banks just don't offer them. Same is true with credit unions. Some mortgage banking companies will offer non-QM along with their regular menu of conforming loan product, but not that extensively. So really the sweet spot for getting non-QM financing is going to be from a mortgage broker. Now that brings up another very important point. We've talked recently about how at MortgageWorks, we charge lower rates in general because we accept much lower lender paid comp than our competition, other mortgage brokers. Remember, I explained how mortgage brokers, when we sign up with a lender, we declare how much we want to get paid for lender paid comp, ranging from 1 to 2.5% of the loan amount. At MortgageWorks, for most of our programs, our lender paid comp is set up at only 1%. In a few cases, slightly higher, maybe 1.25%. Whereas most mortgage brokers, in fact, the average in the US, typically charge at least 2% lender paid comp. They tell their lenders, we want 2% when we deliver this loan to you. So that's going to squirt out to you, the borrower, in a higher rate. Now, it gets even worse on a non-QM segment. Why? Because a lot of mortgage brokers will have their conforming lenders and their non-QM lenders, and they'll set up their lender paid comp at even higher than 2% with their non-QM lenders. The reason being, everyone expects a non-QM loan to cost more, so why not have the broker who's setting up those relationships with non-QM wholesale lenders declare a higher level of lender paid comp to be paid to them when they deliver those loans to those lenders, because it's an expensive loan anyway. We want to get our cut and make more per loan. At MortgageWorks, we don't think that way. We charge the same 1% on most of our programs, including non-QM, the segment of the industry that is expected to have higher rates and higher fees. Well, we are highly competitive because we're not charging more for lender paid comp just because it's a non-QM loan. So if you're of that borrower profile and you need a non-QM loan, I would urge you to contact us. Contact me. I would be happy to give you a written, no obligation quote. I'll provide you a worksheet with all the numbers for the loan, down payment, closing costs, itemized, all the numbers you can possibly see, all on one piece of paper. Please call me if you need that help, just to shop around and make sure you get the best deal. So again, if you're looking for non-QM loan, go to mortgage brokers. They're your best source. And then be sure to get a worksheet from us, just so we can help make sure you're getting the best deal possible. Thank you.